Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell in stocks. We are higher here. The Dow's up about 250 points. The S&P 500, your broad gauge, is up about 0.6%. Tech-heavy NASDAQ is up about 0.5%. And the Russell 2000, those small caps, they're actually leading the way here, up 1.2% right now in today's trade. Well, technically not even the Santa Claus rally yet on Wall Street, but the bulls still in charge. Join me now, we got Eric Ditton, the Wealth Alliance President and Managing Director. Eric, great to see you. So wrapping up 2025, Eric, as we head into the new year here, you emphasize strong seasonal trends. Eric, you point out solid earnings growth. You do raise some questions on your radar as well. What would those be, Eric, as we head into 2026?
Well, first off, always a pleasure to be here. Thanks for having me, Josh. There's a lot of great momentum. I think the questions are simply one, valuation, right? And we know that. Concentration, right? We know that the top 10 stocks in the S&P now account for 40% of the value of the S&P. That is as concentrated as we've ever been. And we actually know from history, if you go back to 1970, once we get over 30% in those top 10, going out the next 5 years, there's a 95% chance that the other 490 are going to outperform those top 10. So I'm concerned about concentration. And then, of course, with AI, look, AI is real. This is a game changer. It's going to change the world. But a lot of this is definitely focused on OpenAI. OpenAI is right out there saying, hey, guys, we're going to be losing money for a long time. We might be profitable 2030. Is the market going to be patient and wait while all this CapEx happens and money's being invested and we're not seeing that ROI yet? Is the market going to be patient with that? I'm not sure. I think there's going to be a lot of volatility.
In terms of that AI trade, Eric, looking ahead in 2026, do you think about, listen, I'll stick with the Mag 7 as a basket, or do you feel like, no, I'm going to have to be more discerning next year? It's going to get tougher. Maybe it's the Mag 3 or 4.
That's a great question. I mean, look, we're not stock pickers at the Wealth Alliance. We're more asset allocators. I think if you own the Mag 7, I think you're going to be okay. Let's not forget, the Mag 7, the last decade, has grown its earnings 20-fold. That is a 35% compounded versus about 8% for the S&P. I think it's okay to have Mag 7 exposure, and you should. My concern is when I see a lot of new clients are coming into the firm, they're just loaded up in tech, and they're not diversified. And I just hit my 40th anniversary doing this, and I remember 1999 and 2000 seeing the same thing. People just loaded up in the same stocks. That always just gets me all nervous. Stay diversified. Look at this year. International emerging markets handily beating the U.S.
Let me ask you, about the AI trade, there was concern expressed by some, including on this show, that, we're too dependent on the AI trade and trend. What's interesting, though, Eric, is, you've seen some AI-heavy names get whacked off their 52-week highs. You can look at charts of Nvidia or Broadcom, and listen, we're still in the green today. Does that give you cause for optimism, Eric, ahead?
Yeah, look, trees don't grow to the sky. We know this. Stocks just don't go straight up. We've had profound moves in companies like Nvidia and for a while there, Oracle. They're not going to go straight up. And it depends on the risk profile. Nvidia's risk profile is pretty low for the foreseeable future. They've just got this tremendous backlog around the world. Oracle, however, is taking a lot more risk. They're going to have to take on a lot more debt. There's a lot of unanswered questions. So it's company to company. But I think you can have that Mag 7 exposure as a portion of the portfolio. I don't think it should be 40%. And be comfortable that looking out the next decade, you should be looking at pretty decent returns.
Let's talk about the small caps, too, Eric. It's been a strong move, especially among, you look at the unprofitable companies, as you point out, Eric. Does that concern you, that move? Is that a sign of excess, or no? Hey, that's a sign of the kind of leadership we want to see.
Well, I like the idea the small caps are rallying. It makes perfect sense. They have underperformed large caps for over a decade. When you have a Fed that's cutting rates, who benefits? Small companies benefit more than large. They're more levered. And it just stands to reason that lower rates are going to help them more. So I'm okay with that. Am I concerned that the unprofitable 40% of the Russell 2000 is beating the 60% profitable by 10%? Yes, that is a lot of speculation. That gets me nervous. I don't like seeing that. I'd rather be in the small cap 600, which, by the way, underperforming the Russell in a big way. The small cap 600 is up about 6%. The Russell's up about 13%. But I believe in quality over time.
Do you want to stay U.S. focused next year, Eric, or do you tell your clients, listen, you should also continue to have exposure overseas?
You've got to have exposure overseas. Look at the dollar. Dollar's had its worst year in 8 years. It's down about 9% versus a basket of currencies. And a lot of that's due to lower rates. And I do think even though the rate is going to slow in terms of decreases, I don't think the Fed is done, especially given what Trump is trying to do and who he's bringing in. Lower rates generally mean softer dollar. Softer dollar is a tailwind for international investing. You got to be there.
Finally, Eric, as we roll into the new year here, where's the Fed in all of this, Eric? We do have reports President Trump could name that new Fed head as soon as early January. You have a preference there, Eric? Waller, Warsh, Hassett, what are your thoughts?
Yeah, I don't want Hassett. I do think it's important for the markets to feel that there's Fed independence. And we all know Hassett is in the Trump posse. And I just think it's too close. And I think the markets could get nervous. I like Warsh. This is a guy with Fed experience, just tremendous Wall Street experience. I think that's the guy for me.
Eric, always great to see you. Happy holidays.
You and your family. Thanks so much.
Now time for some of today's trending tickers. Going to start here with Nvidia, the AI player moving higher as the company is reportedly gearing up for shipments of its chips into China next year. According to Reuters, the chip giant is in talks with clients to start shipping out its H200 chips by mid-February. Despite these plans, there's still plenty of uncertainty, of course, as there is no guarantee that the arrangement won't fall apart. Nvidia has become a negotiating chip for the two countries, and thus its AI chips could be banned again. Turning to D-Wave, those shares are jumping after the company announced it will participate in CES 2026. That's a massive global tech event. There, D-Wave plans to showcase its quantum computing technology and real-world customer use cases. The company will present a masterclass and demo on Wednesday, January 7th. This comes as quantum computing stocks are also seeing bullish options activity. And lastly, a look at Warner Brothers Discovery, the takeover battle heating up as Paramount turns its deal up a notch. In its amended offer, Larry Ellison, the father of Paramount Skydance CEO David Ellison, will personally guarantee more than $40 billion in equity financing for that deal. He also agreed not to revoke the Ellison family trust, and Paramount raised the termination fee of the deal to $5.8 billion, matching the number from Netflix, but Paramount did not raise the offer price from $30 a share. The move is enough to have some predictions change on who will close the Warner Brothers acquisition. According to Polymarket, Netflix is still seen as the most likely winner of that takeover battle, but the streaming giant did see its lead slip, its odds dropping from 68 to 61%, while bets on Paramount saw a 7% jump. Well, coming up on Market Domination, it's a deep dive on commodities. We've got you covered across the board, from gold and silver hitting fresh records to crude oil jumping amid rising tensions over Venezuela. Plus, let's check on crypto. We have a look at what's driving the recent rally in Bitcoin. Bitcoin has spent 2025 in a turbulent up and down pattern, but as U.S. banks deepen their involvement in digital currencies, there may be a sliver of light in an otherwise cloudy crypto market. Yahoo Finance's Inez Foray joining us now with the very latest. Inez.
Yeah, Josh, and today we saw Bitcoin bumping up to 90,000 per token. This is as JP Morgan is reportedly considering crypto trading for its institutional clients. So that sent the token higher and the rest of the crypto space higher. But as with other sessions, we have seen that it hasn't been able really to maintain those levels. And then you see some selling in afternoon trading. Look, we've been in a range bound mode here for Bitcoin over the last several weeks. You can see the range bound there after it sold off and from 120 the 126,000 level in October. It has tumbled in October and November. Strategists are basically saying that you could be seeing a better entry point going into 2026 because there are a few headwinds that investors should keep in mind. One is the threat perhaps of another government shutdown in January. Then that foreseeably could be a headwind. If that's the case, who will be the next Fed chair? But then again, there are tailwinds as well going into 2026. You've got liquidity that should be improving next year. You've got a run it hot policy that's expected, and the expectation for long-term holders for their selling to sort of subside in 2026. This is part of the reason why we've seen this big downturn with crypto are those OGs that have been selling in October and November, and ETF flows haven't been able to keep with that selling. But careful chasing the rallies is what some strategists are saying also, because the cost basis for the sellers who bought 6 months or later is around $103,000. So they may be selling into these rallies. Josh.
All right, Inez, thank you. Appreciate it. Well, from digital gold to the real thing, some of the biggest gains in the market today coming from the metals, both gold and silver climbing to new records. And joining now, we got Phil Streible, Blue Line Futures Chief Market Strategist. Phil, it is great to see you. As always, Phil, your timing is impeccable because we got gold and silver hitting all-time highs here, Phil. Let's start on bullion and just the blistering rally we've seen, Phil. First, just help us explain what you think explains the rally in gold, Phil. Would you chalk that up to, is that the Fed? Is that central bank buying? Is that geopolitical tensions? Is it all three, Phil?
Yeah, it is. It's multiple structural drivers. They're continuing to support gold, and its strength is shown in the price. I mean, you look at central banks, they've been diversifying away from US dollars, other currencies. They've been increasing their gold reserves, adding that structural support to prices. And this really began in 2022 with Russia and Ukraine, where Russia really shifted a large portion of their FX reserves into the gold market. So the average central bank, they hold about 20%, where China only sits at about 6 to 8%. So we believe that the goal is to bring this up to 30%. That's a lot of those emerging market. There's central banks here. So this sets up for a multi-year trend with them continuing to increase those gold holdings. And then you get the ETF flows and the portfolio diversification. So if you look at year-to-date percentage change on ETF flows, up about 18% this year, and more individuals and institutions are recognizing gold as a key cement of strength in their portfolios.
Do you think, Phil, I've seen some strategists say they also chalk this up to the decision by the EU to freeze Russian central bank assets. And their point is they think other central banks around the world saw that and thought, okay, yikes, we better own something that can't be taken from us. What do you make of that?
110%. You nailed it right on the head. That's exactly what happened because of the fact that Russia stored a lot of their assets on certain payment systems and stored these assets. And then all of a sudden those get frozen, and you start to look at, like, if you're Saudi Arabia or you're some other country out there, you're going to go, wow, this could happen to me as well. We probably want to bring this down just a bit, and we want to increase our gold holdings and other key metals. And that's what's happening.
So now, for looking ahead, what do we expect to see? Let's put a number on it. So Goldman's base case next year, Phil, 4,900. They tell clients they see upside risk. Does that sound right to you?
Look, Josh, you got to get through 4,900 in order to get to 10,000. That's the reality. So I believe that gold prices $5,000 in 2026 could easily come. I mean, look, we're at 44.70, up $83 on the day. The average range is $86. I mean, in reality, if it continues this trend, something like we saw, like look at a weekly chart on platinum, gold could be at $5,000 by the end of the by the end of 2025, let alone anything into 2026. I think that you got the support from the Fed cutting, and investors are just getting smarter. That traditional 60-40 portfolio is dead. People are realizing they need to add strategic key commodities to it, such as gold, silver, copper, to their portfolios for diversification. So you're just getting this rising tide lifting all boats.
So you mentioned all the reason for optimism, Phil, but what are, before I move all into gold, what are downside risks I do need to consider?
Okay, all of a sudden, this crude oil prices, it's up $1.40 right now, up 2.6%. Crude oil futures suddenly go into this raging bull market, geopolitics increase, inflation is back in play, oil's at $75, food inflation starts taking off as well. Next thing you know, the Federal Reserve, they got to turn hawkish, and they got to start talking about raising rates. And then that would be the problem for the gold market right there. That would probably be the number one problem that could occur with the gold market.
What you mentioned silver before, Phil, also what a move. What are you looking for in 2026 there? What are the levels you're watching?
Well, I think that, silver, realistically, we were running the numbers like what would 65 to 1 with gold at the ratio, gold silver ratio with gold at 5,000. I think realistically, we could see something like $75, $80 silver. It's the best performing commodity. It's tied into that copper market. You got that energy transition taking place where, copper, silver, they're vital for electric vehicles, power grids, renewable energy. Data centers and AI are needing mass amounts of energy, and that's where copper and silver take off to the upside. You also have mining issues, production cuts, operational challenges, and it's just an underinvestment in that area. And you're seeing these countries really come out and they want to hoard strategic materials, minerals, things like that. And silver, copper, platinum, palladium, they're all one of them.
What about, Phil, I'll get you on this, we're talking metal. What about the miners, the gold miners specifically? You want to stay long there?
Yeah, miners have been fantastic. I mean, they've just gotten this tailwind from the price action there. All of a sudden, some of the core that they have that they've dug up, which it has not been able to pay for itself and being refined and being sifted through. Now, all of a sudden, with prices where they're at right now, some of the material that's been not as profitable all of a sudden comes to the table. You get the tailwind of lower interest rates. I mean, the only thing you would want to watch is like the M&A activity, because a lot of times, rather than them returning the capital to shareholders, they go out and they buy other mining operations, and that's where M&A pick up. And a lot of times these miners don't make the best decisions when it comes to that.
Phil, always great to see you and to have you on the show. Happy holidays.
You too. I want to see you soon. I'm going to come out there.
You got it. Anytime, Phil. We'll take you any day of the week.
Thanks.
Turbulence in the oil market has been heating up throughout 2025 between geopolitics and discourse over supply. Trading in oil is finding itself in a fight zone. Here with more is CIBC Private Wealth Senior Energy Trader Rebecca Babin. Rebecca, great to see you. So you say here, this is interesting, Rebecca. You say crude is trading like a market at war with itself. That's interesting, Rebecca. Explain that for us. What do you mean by that?
So you have a couple competing narratives that kind of do battle themselves each day in crude, right? So we have this fundamental story with increasing supply and a massive surplus that is expected to hit the market kind of right now and into the first quarter. That excess supply is looking to be around 2 to 2.5 million barrels a day, which is very significant. And that's been kind of the genesis behind all the bearish sentiment that we've seen in the market and pressuring crude lower. Now, the battle against that has been the geopolitical side, where we get a lot of headlines and a tremendous amount of noise and fear around potential supply loss. Now, that's just not coming from one region. That's coming from Venezuela. That's coming from Russia, Ukraine. That's coming from Iran, Israel. So this is just that there's kind of ballooning out the geopolitical side. So that's one element where we see the narratives kind of fighting each other. The second place where we see crude at war with itself is this physical market versus the paper market. The physical market remains fairly balanced. We are still in backwardation in the first 4 months of the crude curve. If we were talking about supplies of 2.5 million barrels a day of surplus, that would be a market where you traditionally see contango set in and crude prices lower. But we haven't seen that because the inventories aren't building in the US, they're building on water and in China. So there's this very aggressive short positioning in the financial and paper markets that's kind of at odds with the physical market. So there's two places where we're seeing the battle take place in crude on dueling narratives.
Let me ask you, Rebecca, you mentioned geopolitics in Venezuela. Can we just drill down into that for a second? Because that's making a lot of headlines, and for good reason. I'm sure investors are watching that and thinking, that sounds like a big deal. How are you framing that and thinking through it as an energy analyst?
That's a great question. So the energy markets are really looking through a short-term disruption in Venezuela as not that impactful to balances. And if we were in a different place and the market was finely balanced, maybe we had small inventory draws, this would have a more pronounced impact. But again, we're in this surplus situation of 2.5 million barrels a day of surplus, and it's really hard to see 500,000, 600,000 barrels putting a major dent into market pricing with that much crude available. So when we think about it as an analyst, we say, okay, it's not that it's tightening the market, it's making the market a little bit less loose. Is that enough to get me bullish? Not really, if there's still a tremendous amount of excess supply out there. Over the long term, it's a little bit more of an interesting conversation. If there are any green shoots of bullishness in crude, it kind of comes at the end of 26 into 27. And if we think about the potential that maybe Venezuela is a short-term disruption, but a long-term increase in crude, if let's say, and we're making a lot of assumptions here, we are able to kind of get a politically stable government in place, and there's investment back into Venezuela, which has a tremendous amount of crude resources. Crude supply could potentially increase in 3 to 5 years in that environment. So that would be pressure on the back end of the curve. So analysts, I think right now see short-term modest disruptions, but are looking further out the curve and saying, okay, do I need to worry about what happens in 27 and 28 with additional supply?
So bottom line, Rebecca, against in this complex backdrop environment we find ourselves in, with WTI here at 58.04, your clients come to you, Rebecca, they say, okay, where do you think we're headed 6 months, 12 months? What are you telling them?
That's a great question. And I think in the 6 months, 12 months time frame, I think we're telling our clients that you can expect crude WTI to try to kind of trade in this 55 to 65 dollar a barrel range. And that puts Brent kind of 60, 65. Maybe you touch 70 if you get a heightened geopolitical environment. But I think what we're really looking for in order to get bullish on the commodity or tell people that we think this is going to be a commodity super cycle like you're seeing in copper or gold is you need to see these inventories and this surplus be drawn down. That does look like it could take place in the late 2026. So it's kind of a wait and see story. I don't think you need to jump in now. You want to wait for the evidence that we've drawn this surplus down and that we're looking at reduced spare capacity. So range bound for now. Look for the latter half of the year for your opportunity to maybe engage with the commodity.
And Rebecca, this discussion we're having here, what does it all mean for energy equities? How should long-term investors be thinking through this?
That's a really tricky one. And I'll tell you this, if you look at energy equities performance relative to crude, they've outperformed pretty significantly. And that's really a feather in the cap of US producers who have been super efficient and then been able to kind of reduce cost, drill longer laterals, and make money even as the crude curve has shifted lower. I think this actually reads well for US producers. The fact that they've navigated this cycle so well, I think we can continue to see them outperform even if crude is in this sideways environment. They don't trade at a rich multiple. They're getting better and better at managing their balance sheets. And if they start to see crude rally or bounce or produce some kind of environment where we get an upward cycle at the end of half of the year, they're well positioned to take advantage of it. So I think you can continue to nibble on the energy equity side because they're really navigating this well and they're not overvalued in any stretch.
Rebecca, you always break everything down so simply and smartly. Thank you.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Going to over to Jared Blickery for a take on what happened in today's trade. Jared.
Thank you, Josh. Green, green, and more green, at least in the major indices and the Russell 2000. So let's check out the scoreboard behind me on the Wi-Fi Interactive. Dow was actually the laggard of the day, but it was still up 227 points, or about just shy of 0.5%. And let's take a look at the intraday price action, the NASDAQ composite, and it was gap and go, really just maintained the morning's gains all day long, and not a whole lot of action after the 10 a.m. hour. Very similar story with the S&P 500, trend day up about 64 basis points that you see there. And we'll also check the Russell 2000, which was leading the majors, and that finished the day up 1.16%. So let's check in on the sector action. And it was a day when we found financials in the lead at the end, followed by materials, industrials, energy, real estate, healthcare. So everything in the green except for consumer staples there. You can also see a little relative weakness in utilities, but those are defensive sectors. And so what happened, pretty broad swath of bullish price action across most of the sectors today, and you can see that in the NASDAQ 100. Chip stocks did well. Standout here is Micron. I'm circling that right there. That's up about 4% today. Not Intuit, but Micron was up 4%. And also WBD, also up more than 3%. If we check in on the Dow, you can see a lot of green there. Healthcare did pretty well. Merck was up 3.6%. Did see some losses in those staples that I mentioned, Walmart being one, down 1.5%. Procter & Gamble down over 1%. For the most part, we saw positive price action. You can see that when we drill down into the technology, inside technology to the semiconductors. There's Micron again, but a lot of green there, not too much red. Similar story for software. I can show you the same thing in disruption and even in meme stocks. So we did see a lot of bullish action today. I'm sorting by performance just so you can see about, what is that, 3/5, maybe 2/3 looking green there today. So across the board, pretty bullish day, and hopefully we see the rest of the week kind of a repeat of today here, Josh.
All right, Jared, thank you. Well, joining me now, we got Laura Castleton, Janice Henderson, Investors U.S. Head of Portfolio Construction and Strategy. Laura, it's good to see you. So maybe start high level, Laura. You know, plenty of bulls come on the show and they say, listen, we're wrapping up this year and we head into 2026, and they say big picture, the economy's resilient, earnings are solid, you know, lower interest rates, the great AI build out continues. What's not to like? You agree with that?
I can't say, thanks for having me, Josh. I can't say I disagree fully with that as we look forward to 2026. It's to be excited for, as we're seeing in the markets today.
What would be concerning for you, Laura? What would be on your wall of worry?
So the number one concern that we're hearing from clients in our end reviews as we're talking about their portfolios into 2026 and beyond, it's clear that AI is the number one concern with clients. You'll have plenty that are trying to avoid because of the headlines in terms of scary valuations within the space. But in my opinion, at Janice Henderson Investors, we have deep fundamental boots on the ground that see opportunities within AI going into the next couple of years, but it's not every single company. So that's probably my biggest worry with clients today is the passive investment into technology, into AI. It may actually be time to switch that investment into active managers that can choose those companies today that are best set up for the future.
Laura, you know, we're having a few audio issues. We're going to try to resolve that and get right back to you. Appreciate it. One of the biggest moments for the economy this year, President Trump announcing sweeping tariffs and delivering a shockwave around the world.
Factories will come roaring back into our country, and you see it happening already. We will supercharge our domestic industrial base.
As the new year approaches, we're taking inventory on what happened since April 2nd. Yahoo Finance Washington correspondent Ben Worschel joining us now with the breakdown. Ben, one of the president's early promises, we recall, in that speech was focused on manufacturing jobs.
Oh, hey, sorry. I thought we had some sound to play, Josh.
Sure, but I'll let you take it, Ben.
Yeah. So jobs and manufacturing is definitely the very first one of Trump's promises. That when I looked back at this speech, that jumped out. What he promised there is that both jobs and manufacturing would kind of take off immediately. And what we've seen in the economy in the 8 months since April is the opposite has happened. We've seen declines in manufacturing each month since April. We've actually seen less manufacturing workers in America, to the tune of about 67,000 between November and April. We've also seen declines in the amount of manufacturing construction investment. That's the number of factories being built. So Trump is talking about how tariffs are going to make America an industrial superpower again. But at least in the initial receipts we're seeing so far, it's moving in the other direction on the manufacturing front, which is the central one for Trump for certain.
Now the White House, I know, might argue, Ben, I think I've actually heard White House officials argue, well, there has been, though, this big jump in U.S. CapEx, capital expenditures, and they seem to imply, I guess, that's going to lead to those manufacturing jobs. Those manufacturing jobs will come. What's your take on that?
Well, but that's that construction spending right now. So what we're not seeing so far, at least in the data, is a huge surge. We're seeing CapEx in a lot of areas, obviously, but not in this kind of manufacturing specifically one that Trump makes a lot of claims on. So far, at least in terms of these kind of core base workers and voters for Trump, that they're not seeing as big a change there, at least as what he was promising early on April 2nd. Another big area that I think he's made big claims on is kind of what tariff revenue brings in. He's talked about tariffs bringing in trillions of dollars and paying down the national debt. He did it there in April, but he also has done it sort of basically every time he speaks. That's another one we're kind of a long ways away from with Trump, in the sense that tariffs have brought in about $200 billion this year. That's real money, no doubt, but that's small compared to the $2 trillion annual deficit, not to mention the $36 trillion annual debt. So we're seeing sort of a small decrease in the annual deficit, but we're still a long ways from the annual debt. I looked back, and when Trump spoke on April 2nd, the national debt was about $36.1 trillion. It's over $2 trillion higher now than it was just about 8 months ago.
And finally, Ben, you looked at President Trump's goal to ramp up economic growth.
Yeah, this is the other sort of major thing you hear from Trump about what tariffs are, the overall goal here of what tariffs are going to accomplish. What he talked about in April was growth like you've never seen. This is an issue, obviously, you talk about on the show all the time but economic growth has been strong this year. The Trump team is hoping for 3% over the year, but that's not a major difference from the 2.8% we saw last year. The overall takeaway from looking back at this speech is just how consistent Trump is on how much he loves tariffs, even though what he's promising just again and again doesn't show up. So I think the factor we're looking for coming into the next year is essentially how much the factors outside of Trump's control put pressure on him to rein in his tariffs, even though he's clearly going to keep pushing them. As he said, I like to say, he's talked about tariffs the same way for 40 years. On
tariffs, Ben, before I let you go, so let's turn it to 2026. If I'm an investor, what am I listening for, Ben? What am I watching out for? What's on my radar? Is it court challenges? Is it carve-outs? Could it be new tariffs? Walk us through it.
Yeah, it's kind of yes to all of the above there for certain. I think the only certainty we know is that tariffs are definitely going to be on the docket for certain in 2026. I have three specific ones for you in terms of what kind of big moments that we're looking for in terms of tariffs in the coming year. The big one you mentioned was court challenges. The Supreme Court is currently weighing whether Trump's so-called IEEPA tariffs are legal. These are tariff authority that makes up about half of Trump's revenue, all that we saw the last year, $100 billion of the $200 billion he's brought in, and there's even scenarios where he has to refund that. So that, and the justices seem very skeptical there. So a negative ruling there would be a major change, obviously, for tariffs going forward. The other one is additional exemptions and changes to his policy that Trump could make on his own. I think it's important to remember that we're heading into an election year, and all signs are that this affordability issue is really going to be weigh heavily on Trump and the GOP. And we've already seen him move on tariffs in response to that. He took off tariffs on coffee, cocoa, things like that, because of these affordability worries and the worry is that basically prices at the grocery store were higher because of his tariffs. So I think the pressure is clearly on him that way. Whether he has to buckle that way remains to be seen. The third one I would flag that's a major one is U.S. and Canada and the USMCA renegotiating that's going to happen this year. That's going to come to a head this summer. We're seeing a lot of positioning from the Trump administration already. The bottom line here is that as much as we've talked about Mexico and Canada so far this year, almost the majority of their goods coming across the border haven't been affected because of USMCA, and a lot of those come across duty free. That changes this year. It's all up in the air, and so we could see major changes in terms of how our trade with Canada, our trade with Mexico on a whole range of goods that have been kind of exempt so far, believe it or not.
Ben, great stuff as always. Thank you, my friend.
Sure thing.
Coming up, one of the big concerns around AI is how powering the technology is raising electricity prices. We have expert analysis on that coming up next. A year can make all the difference in the AI race. When looking at the start of the year to the end of 2025, the leadership board looking very different, with Google taking the biggest leap forward. Yahoo Finance's tech editor Dan Howley joining us now to discuss. Dan.
Yeah, Josh, Google came into the year as kind of a sort of also ran in the AI race. OpenAI was clearly in the lead with their ChatGPT and latest GPT models, but that all seemed to change this year with the release of Gemini 3 just recently. Now companies are saying that they're more interested in Gemini 3. We're also seeing some growth numbers out of Gemini 3 that are really starting to give a little bit of pushback against ChatGPT as the leader in that space. In fact, Deepwater Asset Management managing partner Gene Munster wrote that Google will be the best performing Mag 7 stock in calendar year 26. And, this is all coming as Google continues to push forward with its AI models. And, it's important to note that while Google is ahead now, it doesn't mean that it's going to be ahead forever. OpenAI launched their own red alert, something that Google had to do when OpenAI initially launched ChatGPT back in 2022. And so they've managed to catch up and then some at this point. And we'll just have to see what that means then for OpenAI.
What, Dan, would you say is Google's secret weapon or weapons with OpenAI? Would it be, Dan, would you focus on distribution there with search and Chrome and Android?
Yeah, I mean, there's a number of things, right? At first glance, there's Android. As you said, you can use Gemini on an Android phone right away. You don't need to download an app. You don't need to go to a website. That's kind of a friction point for people versus ChatGPT, which requires you to download an app or go to the web, unless you're using something like Apple Intelligence, which has ChatGPT built in, but it's not necessarily something you can use regularly on the fly. They also have the ability to make money, right? They're bringing in cash flow positive because they have their advertising business. They have their Google Cloud Platform business. They have YouTube. And so they have all of these different points where they can pull revenue from and then put that money to work. Whereas OpenAI has more than $1 trillion of commitments for spending over the next few years, but they're not cash flow positive at this point. Sure, they have revenue, but it's not overcoming the amount that they have to spend. And so you could see that kind of back and forth between, OpenAI, obviously an innovative company, Google, a longstanding tech juggernaut, invented the technology behind these transformer models, and now standing on top. It's beyond their AI as well. They also won kind of a ruling in one of their antitrust cases where they weren't forced to give up Chrome, and they could still enter into deals where they allow companies like Apple to distribute Google's search on their devices. And so, they were winning on legal fronts. To a degree, Waymo is also a big win as well. They're now doing freeway driving and things of that nature, expanding to more cities. And then again, just on AI, they continue to seem to dominate at this point. But as I said, that doesn't mean it's going to be that way in 2026. OpenAI is going to be working on better models, and Anthropic is also working on better models. So it's going to be this continuous back and forth. But for now, it appears that Google's in the lead.
Dan, thank you. Appreciate it. Well, data center and AI demand is moving fast, and electricity supply has been able to keep up. But as we look further down the road, powering up the AI boom will come with a not so pretty price to pay. Dave Cherney, PA Consulting Energy and Policy Leader, is here now with this challenging energy landscape. Dave, it is great to see you. So maybe, Dave, start at a high level. You look at these higher electricity prices, Dave. Do you look at that and say, okay, that's cyclical, or no, this is something more structural? These higher prices, they're here to stay.
Josh, thanks for having me, and it's a great question. And so those higher prices, I think, are here to stay, at least in the near term. We've seen a run up in electricity prices across the U.S., partly driven by AI and data centers, but there's a number of other factors. Capital costs for new build power plants are increasing. We've seen the retirement of some aging infrastructure. We have additional transmission and distribution lines that need to be upgraded. And that all being said, on any given year, weather can be a really important factor in what overall power prices are. But in general, I think we're in an era of rising prices.
So if those electricity prices are here to stay, Dave, and they're going to keep rising in throughout the U.S., how far do you think those prices could go, Dave?
It's another great question there. So there's a couple of factors at play. So certain markets have price caps limiting how high prices can go. That being said, the political appetite for pricing at those top levels is really challenged at best. And so we are seeing a number of different system operators, policymakers, regulators across the country start trying to change the rules, which always happens within these competitive markets, to help really focus in and hone in on affordability. So we're going to see, I think, some evolution in market rules. But in general, in any given hour, prices can go within each market up to the price cap.
Dave, are there, somebody who thinks a lot about this, I mean, is there a solution or solutions that would help, perhaps mitigate the cost shock for consumers?
So there's a lot of different potential solutions. There's no silver bullet, right? If it was easy, we'd already be doing it. One of the most interesting things that I think we've seen over the last 12 months is PJM, which is the grid operator from, you call it Chicago through New Jersey, covers 13 different states, at least portions of 13 different states. It's the largest wholesale energy market in the world for electricity. They have implemented what they call their critical issue fast path, which is really a stakeholder process trying to accelerate the innovation of new ideas to mitigate, one, cost to consumers, two, bring new power generation onto the system quicker, and three, ensure a much more highly reliable grid. Typically within these processes, in sort of a standard process, it takes 12 to 18 months to start working through the regulatory pathway. Sometimes it can take years to see change. And so what they're trying to do with this critical issue fast path is throw a bunch of ideas on the table, argue about them, figure out what may work, what may not work, and really move forward with some of those solutions. So some of that is yet to be seen, but we're seeing a lot of interest in demand response. So essentially, for example, if data centers don't need to have capacity backing them, so a power plant backing them, essentially to turn the light switch on when they're needed, demand response essentially allows the system operator to shut them off in periods of real high grid stress.
There was, in your world, Dave, that you think so much about, there was a story, I'm sure you saw this, what happened in San Francisco. Bloomberg had the write-up here that Waymo's driverless ride services, they were, I guess, affected by a power outage out there in San Francisco, Dave, cars freezing up mid-ride. It brings up this question, Dave, we're talking nationally right now, but are there regional differences, important regional differences, Dave, we should know and be conscious of, just in terms of different markets and different regions in terms of their regulatory flexibility?
Yeah, no, absolutely. So the way I think about the U.S. is there's about 15 different electricity regions. We're not one wholesale market across the country. So areas like PJM I was talking about operate under a competitive market. Most of Texas is within the ERCOT market. That's a highly competitive market. But we have other regions around the country. I'm based in Colorado, where we're in a vertically integrated, sort of a traditional utility model, where there's a single owner and operator of the transmission grid, where I don't have a choice of who I can buy power from. And so really across these different regions, there's different regulatory constructs that we're going to have to work through. There's also differences in supply and demand. Further out east in general, we've seen a tightening of the market, as well as in California, where supply and demand is quite tight, which is why we're seeing some of the uplift in pricing. There's other areas of the country that are heading in that tighter direction in terms of supply and demand, but have a little bit more headroom on their plate.
A question about the hyperscalers, Dave, those tech giants. As you can imagine, we talk about them a lot on this show. You note they have prioritized speed to market over cost. Do you think that changes next year, Dave? And if so, how could these tech giants sort of lessen the cost penalties they'd be paying?
Yeah, so speed to market is certainly on the forefront. That's not to say that the tech giants are insensitive to cost, but we've seen a number of different strategies out there. So we've seen a willingness of these tech giants to engage in really long-term 15, 20-year power purchase agreements, which really helps bring down the cost of their procured power. We're seeing them explore options in terms of demand response, like I was speaking about earlier, where they're willing to shut off during periods of real high system need. Interestingly, today we saw an announcement that Google is going to acquire Intersect Power for just under $5 billion. I think it was $4.75 billion. That's a developer largely of solar and battery storage. And so I think what we'll see is a trend of certain hyperscalers starting to jump into the power generation ownership business, which is really a first over the past year.
A final question, Dave. The political pushback on AI data centers has been interesting, how it's affecting electricity costs, what it means looking ahead. The Journal had a piece on that. I don't know if you saw this. The headline, "The political left is dialing up scrutiny of data centers." I'm just curious what you made of that, Dave, when you saw that. And I think you have to assume if the populist left is picking up that baton, you would think the populist right will be on it pretty quickly too.
Yeah, so I didn't see that specific article, but there's been an increased scrutiny on data centers and general demand from AI. Part of the challenge is this is new to the world, and we're not quite sure what the ultimate level of demand. And so there's a lot of guesswork going on. The PJM interconnection has puts out an annual load forecast, and they've signaled in their upcoming load forecast for 2026 they might actually be scaling back what they have put forward within their 2025 forecast. And part of that is they're starting to figure out how to do better diligence on data centers, what is actually going to come to market and what is not going to come to market. And so certainly from a populist standpoint, lower prices are in general preferred. We're going to see continued push there. But at the end of the day, I think there's a lot that remains to be seen just in terms of what's real and what's not real.
Dave, it's a big, complex, important story. Thanks so much for helping us think through it.
Thanks for having me.
Let's get back now to Laura Castleton, Janice Henderson Investors U.S. Head of Portfolio Construction and Strategy. Laura, we had some technical difficulties there. Hopefully we may our way through that. I was asking you, Laura, there's a lot of bullishness on the street. There's a lot of bullishness I hear on this show. I was curious, when you look out to 2026, what would be some risks, though, in your opinion, that investors need to think about? What's on your wall of worry, Laura?
Yep, let's hope this works better this time, Josh. It's not all rosy into 2026. We're definitely cautiously optimistic, I should say. As I was talking about with the AI trend in particular, it's not just a broad swath every single company. So fundamentals are more important than ever in any type of equity investing right now. You've heard a lot in the show earlier. There's going to be winners and losers across every sector. And so client portfolios that are still overly allocated to passive really need to be thinking about shifts in terms of how they can incorporate bottom-up fundamental active management, because the cost of capital has been back for quite some time, and you're now starting to see that come to bear, and earnings and balance sheet strength is really important as you head into next year.
I was talking to a strategist on the show earlier today, Laura, and was concerned about concentration in the market. That was a worry for him. I'm interested. I'm looking at the S&P 500 equal weight here. It is up about, it's up 10% year to date. Does that suggest some broadening to you? And do you expect more broadening in 2026?
Absolutely. We've actually seen quite a bit of broadening, even in certain areas of the market since tariff announcement in April. So looking forward into next year, we absolutely think that can continue. The S&P is no longer just driven by those seven. You're starting to see other sectors, other companies, even within the large caps, start to catch up. So investors should definitely be thinking about how to position portfolios next year for some of the areas that are not only going to take advantage of the AI transformation and have strong earnings growth, but where there are bargains to be had elsewhere in the market. And that comes from not only just some down and cap equities within US, some other sectors, but even looking abroad.
Laura, I'll get you out of here on this. We're waiting for our next Fed chair. Reports indicate Trump could be naming that person pretty soon, actually. Does that matter a whole lot to you, Laura? Or do you think, I don't know who the president is going to name, but I can be pretty confident that person is going to have a cutting bias? I'm just interested to get your take.
I think it is fairly certain that it's been difficult to predict what Fed policy is going to look like heading into next year. So rather than being focused on exactly how many cuts might happen in 2026, we're looking at maybe 1 to 3, which seems reasonable given the economic backdrop. But rather than try to put a name on how many are going to come from the new Fed chair, we would rather optimize portfolios within fixed income for unit of yield per risk in the portfolio. So in other words, maximize the amount of carry that you can get. And there's a plenty of opportunities within the fixed income markets that are going to be resilient no matter how many Fed cuts actually materialize into 2026.
Laura, glad we got those technical glitches worked out. Appreciate your time today.
I appreciate you. Thank you.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.